In January 1995, the United States made a bold and controversial decision. President Bill Clinton approved a $20 billion aid package to Mexico, marking one of the largest economic interventions in modern history. But why would the US risk billions of taxpayer dollars to bail out its southern neighbor? To understand, we need to rewind the clock and unpack the crisis that shook the Mexican economy to its core. It all started in December 1994, when the Mexican peso suddenly devalued. The spark was a sudden decision by Mexico's government to shift its currency policy, allowing the peso to float freely against the dollar. This move caught investors off guard and triggered a mass exodus of foreign capital. What followed was financial chaos. The peso lost half its value in a matter of days, inflation skyrocketed, and foreign investors scrambled to pull out their money. The world watched as Mexico's economy teetered on the edge of collapse. But this wasn't just Mexico's problem. The peso crisis threatened to spill over into the global economy, especially in the US. At the time, Mexico was America's third largest trading partner under the recently signed North American Free Trade Agreement, or NAFTA. A collapse could devastate US exports, destabilize financial markets, and trigger waves of illegal immigrants. The stakes could not have been higher. Enter Bill Clinton. His administration quickly recognized the urgency of the situation. Clinton's economic advisors quickly realized that failing to act could have catastrophic consequences for both Mexico and the United States. But there was just one problem: convincing Congress to support the plan. The idea of bailing out Mexico was deeply unpopular with many in Congress. Critics argued that the American taxpayers shouldn't be on the hook for Mexico's financial mismanagement. Some even saw it as rewarding bad behavior. Meanwhile, others feared that the crisis might create a dangerous precedent for future bailouts. In Mexico, the situation was equally fraught. Many citizens viewed the bailout as a loss of national sovereignty, particularly when Mexico's most prized asset, oil, was used as collateral. Pemex, the state-owned oil company, was generating $7 billion a year in revenue, and those revenues were now pledged to secure US loan guarantees. For Mexicans, this was a tough pill to swallow. Despite the backlash, Clinton's administration pressed forward. To bypass Congress, they tapped into an emergency fund called the Exchange Stabilization Fund, which didn't require congressional approval. On January 14, 1995, Mexico pledged its Pemex revenues, and within days, the US Treasury began issuing the $20 billion aid package. But would it be enough to solve the issue? The bailout worked, but not overnight. Mexico implemented a series of harsh austerity measures, including cutting public spending, raising taxes, and increasing interest rates. These measures were painful, but they helped stabilize the peso and restore investor confidence. By 1997, Mexico had not only repaid the loans, but also paid the US a $500 million profit from the interest. It was a rare economic success story. The 1995 peso crisis and the US response offer powerful lessons about global interdependence. Mexico's recovery demonstrated resilience and the importance of international cooperation. But the crisis also highlighted the risks of relying too heavily on foreign capital and the vulnerabilities of emerging markets. So, was the US bailout of Mexico in 1995 a wise decision? While it remains a polarizing topic, one thing is clear. It prevented a financial disaster that could have reverberated across the globe. And in doing so, it cemented the idea that economic stability in one country often depends on the stability of its neighbors. So what do you think? Was the $20 billion aid package to Mexico a necessary move or an overreach? Let me know your thoughts in the comments below. And don't forget to like, share, and subscribe for more stories that shaped our world from 30 years ago.